Welcome to Trading Basics. As I said earlier, I am so excited to talk with you guys about this. And my secret motive in doing this class live is that I want you all to be up and running trading so that you can be trading futures with me, because that's really where the action is. That's really where the fun stuff is. And like way more money potential, quite honestly, because of the leverage. That being said, you have to get started somewhere. And the best place and the safest place to begin is by trading stocks. So that is where I started. That is where I cut my teeth. And then a lot of people from that point move up to either options or futures or both. There's plenty of different things to trade. And the thing with options, I didn't really like them. I learned them, I started trading them, and I was like, it's not my thing. So some people think that you have to go stocks to options to futures. That is not true at all. So I don't want you to think that, but I do recommend that you start with stocks. So what we're going to do today is in the next couple hours, we are going to look at a ton of different examples, and I'm going to show you exactly what I do and talk about not just what I do, but a little bit of the mindset behind why I do it. I'm going to cover some of this stuff up because it's just not necessary for our purposes here today. So we are going to begin very macro, high level conversation. And please, as we go, if you have any questions, drop them in the chat, because I want this to be conversational. I want it to be interactive. I don't want it to be just me talking at you for the next couple hours. It's way more fun for everyone if y'all are involved. So where we're going to begin is we're going to drill down from stock market overall to individual stocks. And you'll see there are different layers of what I'm going to be talking about and showing you all along the way. And we will be looking at a whole bunch of charts, as you can see here on your screen. And honestly, some of you may decide that you're like, I don't even like this. I don't want to look at charts. I don't like looking at charts. And that's totally fine too. Like, trading is not for everyone. It is difficult. It is challenging. It is frustrating at some times. And it can also be super lucrative. So I got bit by the trading bug, totally fell in love with it. And that is going to be up to your own decision and your own preferences to see how you want to trade. I'm going to talk about a lot of different ways that people do trade in different time frames, all of these different things. And yeah, Sheila, that's actually one of the things that I will talk about in depth about trading platforms, because that is super important when you are starting to trade, what the heck you're going to use, which platform. First and foremost, though, let's talk about trading versus investing, because I want to be really clear in the terminology that we are using. A lot of people, and I certainly was one of these people back in the day when I didn't know what I was talking about, I thought trading and investing were the same thing. I was like, trading, investing, like, what's the difference? Totally the same thing. However, what I would say now is that investing is something that you are in for long term. So you are going to put some money into something and hopefully just not look at it, because the people that kind of try to micromanage their investments, they usually tend up doing worse. So it's just like, put your money in there, hold it, don't touch it. And that could be for multiple years. What I would recommend, if you want to do that, and it, quite honestly, it is the safest way to invest your money, is to put it into something and hold it. There's a great book that I will recommend to you. It is called The Simple Path to Wealth. I think everybody should read it. It's by a guy named J.L. Collins. And what he talks about is straight up investing. And the platform or the brokerage that he recommends is Vanguard. And here's why. John Bogle, who is the founder of Vanguard, he had this really good idea. He was like, what if I could just invest in the whole of the stock market, like everything, buy everything? And so they created these funds that essentially are the whole of the stock market. So as you probably all know, over time, almost all the time, not always, because there are certain time frames of a duration of years that actually didn't go up. But for the most part, for the majority, for sure, that is a pretty solid investment because in general, and I'm like super clear about the way I'm saying that because it's not always, but in general, the stock market does go up. So again, that would be the safest way to invest your money is just to put it in something like Vanguard. And if you do read that book, Simple Path to Wealth, he talks about all the reasons why, how it works, all that stuff. I have done that. So I do have a Vanguard account. And when I first talked to one of my trading buddies, a guy who's a professional trader, he was like, Mindy, don't even trade. You're going to lose all your money. He's like, just put it in Vanguard. So that was his advice to me. I am passing on that advice to you, but that would be what is considered investing. Okay, so now we're going to talk about trading. There's essentially two different types of trading, and different types work for different people. And it depends, again, on your preferences and how you want to do it. There's something called swing trading, which would be either a few days to a few weeks to a few months. That would be a swing trade. If it gets into years, now we're talking back to investing. So we're not, that's different than a swing trade. A swing trade would be a shorter term play, either days to weeks to months. And then there's something called day trading, which is basically you get in and you get out on the same trading day. Now, that's the kind that I like to do, but I still do have some swing trades, and I'll show you one that I did. And I actually just made a video about it, so some of you may have seen this, but I was trading. This is the 10-year note, which is an interest rate product, a bond product. And just to be clear, this is a little different than the stock market per se, but wanted to give you an example of this trade. So if we scrunch this thing down, this is a 10-minute chart. And I was in this trade since Wednesday night. So you see these yellow lines, that is a break in the session, which basically means it closed and then it reopened again. So I was in this trade from back in here on Wednesday night. I held it all the way through here. It didn't really do much. And then, as you can see, yesterday, the market gave me a really nice gift because I was short this thing. So I wanted it to go down. So it had been like a little bit down, and then it kind of flattened out, went sideways for a while. And then it was like, bang. So that was an over $1,000 trade yesterday, which was awesome. And that was an example of a swing trade because I was in it from here Wednesday night, held it, and then I got out of the trade down here. So that's an example of a swing trade. Most of the time, what I do is I'm looking more shorter term on the same day, because what I could have done is I could have gotten into the trade here on this day, shorted it, wrote it down, and then got out here before the close of the market on Friday, yesterday. So that is just one way of doing it, is swing trading. You can also day trade. And that is the difference between trading versus investing. I'm going to give you another example of something that is a longer term hold for me, and that is Palantir. Now, let me move over my little chat window here so I can see my full screen. If you look here, and I hope you guys can see this, in the top right corner, let me move this over. This is a daily chart. Actually, let me make it bigger so you all can see. So each candle, and I'm going to talk about this in depth in a little bit, but each candle represents one day on this chart. And as you can see, this, this company, Palantir, is not had a very great few months. I used to trade it a lot when it was up in the 40 range. Let me see if I can scrunch this down even more so you can see. Yeah. So like when it was up here around 40, I was trading it actively in and out, made some good money on Palantir. And then I was like, I am going to pick this one as a longer term hold. I'm just going to throw some money in it and I'm not going to touch it. Well, the problem is that where I got in, I'll draw a little line so you can see. Where I got in was around here. It was 25 something. And as you can see, it's done crap since then. It's basically just gone down, and it's now traded down around $10, which is terrible. But the difference is I can hold this thing for as long as I want to hold it. So if I ever decide I'm like, screw this, I'm out, whatever, I'll just take the loss because in this case, I was wanting it to go up. I could just take the loss, but the reality is I have years to hold it. That's the beauty of the stock market is you never have to sell or you never have to get out of the trade. You can just hold it and hope for the best. Now, is that always the best case scenario to do? No, because you may have opportunity costs if your money is locked up like in this mess. If I were to pull it, maybe I could, save some of that and then put it into other things that would make some more money sooner. But because I had decided that this was going to be a long-term hold, I try not to look at it because if I look at it, I'm like, seriously, you're down at $10 and you were up at, 40, 25, all these much better numbers. And anyway, I won't go into the whole details with that particular company, but it's a little bit frustrating. So that would be an example of a long-term hold versus the swing trade that I did that I just showed you versus what I normally do, which is a day trade. So hopefully that all makes sense in terms of those three types: investing, swing trading, day trading. So let's move on to the stock market overall. I want you all to have an understanding of like how this works. And basically, each company that is on the stock market. Okay, Jeannie says, hope you talk about companies and how you research as far as picking. Yes, ma'am, that is coming up. So the stock market as a whole, they are public companies. You may have heard a term called IPO or initial public offering. That is when a company decides to go public. That would be like me taking my company, Lucra, which is currently a privately held company. I own 100% of that company. So all the equity is mine. And I'm like, oh, I want to bring this forward into the public and do an initial public offering so that what I would do is I would divide my equity or my company into shares, and then I would sell those shares. And that can be a great thing for companies because it can help them just get more money and honestly, more publicity and all kinds of other things that go with being a publicly listed company. And you want to think about it as it is equity. So stocks are also called equities, and you have equity in the company when you purchase a share. So when I purchased shares of this company, Palantir, I now own equity in that company. So the way that I like to think about the different companies in the stock market, it's kind of like they're employees, right? Or partners, if you will. Like if I'm an equity partner, and in this case, like Palantir is pretty crappy right now. So the potential for me firing them is relatively high. If I hadn't decided in advance that I did want to do a long-term hold on this, I would have been out so fast, like up in here when it dropped to 20, because come on, that's just ridiculous. So you don't have to stick with a particular company. You can try it, you can get out, or you can decide to stay in. Now, every company has what's called a ticker symbol. And this one, Palantir, is PLTR. And you can see, we'll just go through a couple different examples that y'all might recognize. AAPL. That is the well-known company called Apple. And as you can see, they've been kicking it recently. They had some awesome stuff going on. And even yesterday, like the end of the day was super solid. So that was great. Another one, AMZN, is Amazon. This is their charts. I'm going to open this thing back up because that looks crazy. Another one that you probably all have heard of, I call these the misfits, but it's really Microsoft, MSFT. This is their chart. So like I said, they all have a ticker symbol, which is how they are recognized within the stock market. And if you ever need to know what your ticker symbol is, you can always just Google. You could say, what is the ticker symbol for Microsoft, or what is the ticker symbol for Apple, or whatever company that you wanted to check on. One thing I did want to mention that I'm not going to go into a ton here, but it is worth mentioning, is there are some companies that will pay out dividends. And there are some traders that, or you could maybe consider them investors, that literally are just looking for dividend companies. And that's how they make their money. They're just looking for that dividend. They're not looking to be a trader to take advantage of price movement like I am, but they're just looking to be paid out dividends. And a lot of those companies are like the bigger, older companies like Coca-Cola, stuff like that. So again, I'm not going to talk a lot about dividends, but just so you know, there are companies that pay out dividends to all of their stockholders, which, like I said, some people really enjoy. One more thing to mention about why trading is so awesome is the stock market, I think, is one of the most equitable things that you can do to make money, because it doesn't matter if you're a man or a woman. It doesn't matter what race you are. It doesn't matter what your culture is or what your religion is or anything. And for me in particular, as an introvert, I really, really love the idea that I don't have to talk to anybody. I know some of you have known me a long time, and that will probably make you laugh, but that's great. I don't even have to leave my house. I don't even have to get dressed, which I also love. And you are able to make money just by choosing the right directions and then being strategic in what you're trading. So my very, very, very first trade that I ever placed, it was last year, January, and I made $38.40. And I was like, oh my gosh, I didn't have to convince anybody to buy my products. I didn't have to do anything. It was so awesome. So even though 38.40 wasn't that sexy, it was quite a delight to me to be able to do this. And I think a lot of you have seen my videos. Is it can go up significantly from there, from $38.40. All right, so let's get to Sheila's question about trading platforms and selecting a brokerage. What I'm looking at here, this is called TradeStation. TradeStation, for me, I have used many, many brokerages. I have accounts at TradeStation. I have account at Thinkorswim, which is also TD Ameritrade. It's the same company. And I would say those two are probably the maybe most well-known or like the most popular in terms of people that are getting started trading. I do also have accounts at a futures brokerage, which is called Infinity Futures. And I have another one at Ninja Trader. So I have lots of different accounts, which what I can tell you from that experience is I can give you some of the pros and the cons. Now, my favorite, the one that I absolutely recommend, it's the one that I use the most. It's also the one that I would recommend to anybody starting out, because I think I don't want to say it's easy, because there is some tech that you have to like figure out and get it set up and sorted out. But I use TradeStation. Okay, so Sheila says she uses TOS. I used TOS for a while. I don't particularly like it. And there's, I don't have any reason for that other than to say like I just resonated with TradeStation better. It just works better for my brain, apparently. So if you want to try out a few, that would be one way to do it. That's the way that I did it. But I know a lot of people don't want to waste their time and like try all these different ones and set up accounts and all that jazz. So I recommend TradeStation if you're starting from scratch and just wanting to, start with something simple. Now, what I'm looking at here on my screen is the TradeStation desktop version. And as I mentioned with our little technical difficulties at the beginning of this call, these financial platforms don't always work well with Mac. Now, the good thing about TOS, I will give them props, they do. So you can download TOS on your PC or your Mac and it works just fine. That's awesome. But I would say most of the other ones, TradeStation included, do not. Yes, I do trade futures from TradeStation. And you can trade them on TOS as well. So that's very open. What I have to do, because I have a Mac, is I had to get Parallels, which essentially is a program you put onto your Mac that then you can run Windows software. So it is a little extra annoying, and there is a little extra cost because you have to buy Parallels, which I want to say, I could be making this up, but I want to say it's maybe $90 for like a whole year to get the Parallels license, but you do have to install that first, and then you can install TradeStation or honestly, whatever else you want to use, Ninja Trader, those other ones. Like I said, TOS does work on both. So props to TOS for that. It's like one of the only ones that does. But I want you all to know, like, that is something to think about. The reason that you're going to want the desktop, though, is because TradeStation does also have a phone app, which you can use, or a web version, but it is significantly not as good on the web version. So you can trade on the web, and that's where I started. That's where I learned TradeStation at the beginning, was just trading on their web version. But when I was able to jump up to this desktop, I was like, holy cow, I have been missing out on all the things that I need to like see and whatever. And my personal preference is I don't love trading on the phone because I want to see all this stuff. I like having all my charts and like big screen and just being able to see everything all at once. I think that is just the way that my brain kind of operates. Like I do that in my coaching business. I do that in trading. I want to take like the bigger view, the 30,000 foot up view, and just then be able to kind of drill down into what I want to do. So that is my preference. This is the way that I like to look at it. But you can do whatever you want to do. Jeannie says, from the moment you get ready to open up your computer and trade platform to when you decide to shut it down for the day, how much time are you putting in during one day? That's an awesome question, Jeannie. So my typical day, I usually only trade at the morning. So I'll wake up, I'll get my coffee, I will, check out, open up my computer, check out what's going on in the markets. And then the stock market opens so for Pacific time zone, where I know a lot of you are, the market opens at 6:30. Now that's pretty darn early, especially for me, which traditionally, Sheila, you know this, I am not an early bird, but because the market opens early, so it's 6:30 during Pacific time. And for those of us in Arizona, it would be 7:30. That is my best and really the best time to trade, because that's when the most action happens. And you want action, you want movement, you want volume. Sheila says, I don't know what you're talking about. That's hilarious. For those of you that don't know what we're talking about, I actually used to live with Sheila, and she was always like, what are you guys doing still in bed? Me and Sean would sleep in. Anyway, that's a whole other story. So the stock market opens at 6:30 Pacific time zone, and I want to be up. I'm usually up I get up around 5:30 these days, because there's some other stuff that I like to trade, what's called pre-market, which is before the stock market opens. And then I'm only going to trade for a couple hours. And if something's awesome happening that day, I may hang out and trade a little bit longer. But realistically, the middle of the day is called, in the stock market, it's called the doldrums. And the reason it's called the doldrums is because it's kind of boring. Not that much stuff is happening in the middle of the day. So I usually will only trade those first few hours of the day. Some people have even less time than that, though. Some people just take a look at it before they go to work. And what got Mindy to wake up early making 38.40? Yeah. You guys are hilarious. This is so hilarious to me that you all know me pretty well. So this is awesome. But yeah, first few hours of the day. And it literally could be, if I was, well, one, I don't trade every day. There's also that. And two, if I did have other things going on that day, different meetings or whatever, I could just take a look at it, make my decisions, and then set up some stuff and leave it. So there's that. Okay, you guys are all going to have a mutiny now talking to each other. Anyway, so Jeannie, to answer your question, honestly, it is going to depend on your preference and your schedule and how you want to do it. Like I said, I'm a sort of a maniac about these things now. I really, really enjoy it. So to me, I may spend a little more time than others spend. But for instance, on this call, I know that Engel works a ton. So you're people like that, you're not going to have time to sit and look at charts all day. So it totally is dependent on how you want to set up your day. For me, that is the best time. And if you can trade the open, like I said, that's going to be the most volatility and most volume. That is most people trading. So that's going to be the best. The next best time would be the close. So the stock market closes at 1:00 Pacific time. And if you're looking at it a little bit before that, that's going to be the second best time for volume and volatility. And then, like I said, in the in-between time, it's just called the doldrums. You might as well forget about it. Now, that's just for active day trading. If you're swing trading and you just put on a trade and then you want to just check in on it every now and again, see how it's doing, which I sort of don't recommend because, as I mentioned earlier, the more people try to micromanage their trades, the generally the worse that they do. So there is that option though, is you can kind of just check in on it throughout the day. And sometimes what I'll do is I'll open up this whole thing on my computer first thing. I might put some trades on. And then if I'm out doing something else, I can always look at TradeStation on my phone and see where I'm at. I also have alerts set up on my phone. So let's say I get stopped out, and I'll talk about what that is later. But if I get stopped out of a trade or I'll exit a trade because I made my money, well, that will alert me on my phone. It'll be like, hey, you just got out of this trade at this price. So I can sort of see what's going on throughout the day as well. So if you guys have questions about specific brokerages, let me know. But just to kind of make it simple, I do recommend TradeStation. They have 0 commission on stocks, which is great, which means you're not paying a commission like I do on futures. I have to pay for every trade that I get. Engel, are most of your trades set it and forget it with futures? No, I do actively trade futures. So I don't often set it and forget it. I'm very, very much looking at it because I am interested in short and quick. And I'm like, give me my money, then let me get off to doing something else. You all know me. I would rather be hiking or doing like reading a book throughout the day. Brokerage does equal trading platform. Yes, same thing. Same thing. So here's the difference. And thank you, Jeannie, for asking that. The brokerage is like the company that provides you with the account. And then the trading platform would be, I would consider that to be the software that they give you to do it on. So yeah, they're kind of the same thing, but slightly different. I hope that makes sense. If not, let me know and I can clarify even more. All right, let's talk about how the stock market is divided up in ways. Yes, Sheila, exactly. So TD Ameritrade is the brokerage and TOS is their platform. In most of them, though, they're called the same thing. So like TradeStation is TradeStation. It's the brokerage and it's the platform. So great distinction, Sheila. That's awesome. All right. You probably have heard of these things called the indexes. There is the Dow Jones, which is very, very popular. The Dow is basically like the biggest 30 companies. So the Dow, while it doesn't have a ton of companies like the other ones, it's in some ways known as like a bellwether of the whole market, because if the Dow is up, and again, this isn't always, there isn't like anything that's always the case in trading because there's always little discrepancies and nuances and whatever. But in general, if the Dow is strong, the Dow is healthy, the Dow is doing well, that can be an indicator for how the stock market at large is doing. So there is the Dow Jones, there's the NASDAQ, which is a whole lot more companies. And NASDAQ is very, very tech heavy. So NASDAQ can be one of the hardest ones to trade because they're so volatile with like different tech companies, different semiconductor companies, there's all kinds of things. And it's not just tech. For instance, my sister, which some of you know, she works at a company called Allbirds in Chicago. Allbirds is a shoe company. Like they're not tech. They sell shoes and their whole thing is about sustainable products and sustainable shoes and clothing. And they just this year did an IPO. So they listed their company publicly for people to trade, and they're trading on the NASDAQ. So it can be confusing. Some people just think of NASDAQ as all tech. And I'm like, not really. It's kind of a wide grouping of people. There's also the S&P, which is one of the other, there's 4 main indexes. So the S&P, and generally people talk about the S&P 500. So that would be 500 companies, obviously very, very different from the Dow Jones, which is only 30. And then there is the Russell, which is not as talked about, but I always love the Russell because it's the little guys. It's small and mid capital companies. You'll hear them talked about as small or mid cap. And me personally, I always kind of root for the underdogs. I'm like, oh yeah, come on, like little guys, like entrepreneurs that just started with an idea and a dream, and they may not be like the big guys, but I'm always rooting for them. So that is the Russell. And what's cool is that for me, I can trade them as futures. So I could trade Dow futures, NASDAQ futures, etc. But there is also a corresponding stock ticker that you can trade these things. And I wanted to just go through and show you what some of these look like. So the Dow, for instance, is DIA. And just to be clear, it's called an ETF, or an exchange traded fund. And basically what exchange traded funds are, or ETFs, is a basket of different stuff. And in this case, the basket is the companies that are contained in the Dow Jones Industrial Average. So what you can see here, let's go to this top right chart here. Let me move this over. This is a daily chart of the Dow Jones Industrial Average. So you can see it was doing pretty well up here. And more recently, with the war and all the craziness that our world is having these days, it has been going down just recently. So this is like, this right here says 22. So that's the beginning of this year. I'll show you, like, this line here is January of this year. And it hasn't had a great year. It actually was way, way, way down here. But you could trade this thing as DIA, as essentially you could think of it as a stock. So that's the Dow. I'll show you the NASDAQ is, and who knows why they make these symbols this way, but it's called QQQ. So similarly, in this top right again, because this is a daily chart, you can see it had some challenges. It's down from where it typically is. Let me move this over so it doesn't get confusing. But it's been way down. And then it had some really like great recovery days. You can see this big green candle right here in the middle. Like, that's huge. That's an awesome day for the NASDAQ. And this is the one, QQQ. You can see it tells you what it is up here. QQQ Daily, NASDAQ, Invesco, Trust Series. Basically, all it means is it's an ETF for the NASDAQ. The S&P then is SPY, SPY. And very similar. A lot of times the indexes will, kind of not merge, but they will be trading similarly. So when one is down, it sometimes will pull the others down, and it goes on from there. So that is the S&P, SPY, and then finally the baby Russell is IWM. So again, very, very similar. I mean, you can see like some of the days were really powerful where there was just a rally and everybody's like, hey, we're awesome. Let's go, America. Stock market is strong. We're going to just buy. And that brought this nice green candle into that. So even though you will hear me, like if you're watching my daily videos on the Daily Rage, I'm always talking about, well, not always, but most of the time talking about futures. But you could still trade exactly what I'm trading, because I trade a lot of the Russell, I trade a lot of the NASDAQ, and more recently I've started trading the Dow. I don't know why. I don't love the S&P, so I don't trade that. But you could trade the same things as a stock. And here's what's actually better in some ways about doing it this way. With stocks, as I mentioned earlier, you can hold them as long as you want to hold them. Like, you don't have to get out of them at any time. So that means if it's down one day, you could, if you wanted to, hold it and hope. Now, hope is not a great plan in this game, but if people do it, you could hope that it does go back up eventually. And I know for me, a lot of times I would get out of something and I would take the loss. And then, I don't know, a couple of weeks later, I'm like, man, if I just would have had the patience, it did come back up and I wouldn't have had to take a loss. Engel, you heard me talk about that a lot back in the day. So like that happened a lot of the times. Here's the only problem with that way of thinking, is that it might not come back up. Yes, Engel. It might not. Sometimes it doesn't. Sometimes they go down to zero. I mean, these indexes are not going to go down to zero, but like on an individual stock, sometimes it doesn't recover. So then it's like, okay, do I want to put myself in the position of taking an even bigger loss if it goes down, and like never recovers? Or do I want to wait? Do I want to have patience and just see, cross my fingers and like pray to the stock market gods that it does go up? But there's no right way to do it. I would say professional traders, what they do, they'll just be like, yo, take the loss, get out, move on. So I had to do that. I had some really significant losses back in the day. And I think, Engel, I probably talked about this in our meetings. There was like a 2000, I don't know, it was a lot. AKA I've stopped hoping Zoom will go back up. Yeah, exactly. Because it may not. Like, that's the thing. It might, but it might not. Okay. So that is one way to look at these different indexes. You can hold them as long as you want them. The difference being when I trade them in futures, futures is always based on quarters. So the futures contracts, and I won't go into this in detail, but basically the futures contracts expire every quarter. So even if I was in, let's say I got in this down here, and let's just pretend that this was like a daily chart or monthly chart. And I'm like, oh man, I just want to hold this forever. Well, I can't hold it forever in futures because my contract will expire eventually and my brokerage will kick me out of that contract. So I'll have to either take the profit or the loss that is at that time, unless I get myself out before that. But with stock market, you can hold these puppies for as long as you want, which is really good because sometimes they do come back and sometimes they do even better. So that is that. Another way to think about ETFs or trading stuff. Oh, let me say this first before I move on. Rochelle, no, because I don't want to get into futures in this. It's basically a contract. Okay, I'll tell you real briefly. Let's say I was Starbucks. And I'm Starbucks and I am in charge of buying coffee for Starbucks. And I'm looking around the world and I'm like, oh, okay. So I think that with global warming and there was a recent weather issue in Brazil where they grow a lot of the coffee, I think there's going to be a shortage on coffee. What does a shortage mean? It means that that stuff is going to be more pricey. So what do I want to do as the Starbucks coffee buyer? I would like to lock in a price. So basically what a future is it's a contract between me, the Starbucks coffee buyer, and the coffee farmers or the coffee growers in Brazil to say, hey, I want to lock in this price. I'm going to buy your coffee at a future date, but I'm locking in the price. So obviously I'm not, me personally, I'm not a Starbucks coffee buyer. So what traders do with futures is we take advantage of shorter term price movement, but that is what the futures contract is. It is for like basically saying, I'm going to buy this at a certain price at a certain time. And the big difference, two big differences between stocks and ETFs. Stocks and ETFs are kind of the same thing. Like ETFs are just a collection of stocks. So the two biggest differences is one, there is an expiration on futures contracts, so you don't have the ability to hold them forever. And two, futures are leveraged, which means it takes a lot less money to get into the contracts than it does to get into a stock. And I'll go into that in a little bit when we talk about like the price of shares and that kind of thing. So the very, very, very easiest way, like other than investing long-term. So that's the most easy way, is just put your money in one of these things and hold it. Like that's it. Then I would say the next easiest, like drilled one level down, would be to invest or to trade these indexes. So like I said, the Dow, the NASDAQ, the S&P, or the Russell, because like I said, over time, in general, they often do go up. But let's say you wanted to drill down even one more layer, and I want to show you this. There's something called sector spiders, or SPDR. And I'll go ahead and just drop this link in the chat if you want it for future reference. Okay, so what these things are is they are groupings. They're all ETFs, and they are groupings of companies based on certain sectors. So for instance, there's 11 of these babies, and you could just invest in the whole of the consumer staples sector, or you could invest in the whole of the energy sector. And that's a whole lot of companies that are in each of these sectors. You could invest in real estate as an ETF, which means like a whole ton of real estate companies are all going to be in this ticker symbol, XLRE. You could just invest in straight up technology. And the difference between this versus like say the NASDAQ is, like I said, the NASDAQ has a bunch of other stuff in it, but you're like, nope, I just want to invest in technology because I think technology is going up. Now, recently, technology has had a little struggle because of supply chain issues and all kinds of a mess. So I wouldn't necessarily recommend that right now. You can see it's down at this point. But this is a really easy way to kind of get your feet wet with trading stocks, because the cool thing about ETFs is that even if one of those companies kind of sucks and is having like a terrible quarter and puts out terrible earnings, hopefully the other companies in that sector will be able to hold it up or buoy it up. So that's why a lot of people think of investing in ETFs as a safer bet, because it's not just one company that you're like, it's not all, like you have all the same eggs in your basket. You've got all kinds of different stuff within these sector ETFs. So like financial companies, healthcare companies, industrial companies, and it's a whole lot of them. So again, this can be a safer way to go. So let's just take a look at one of these things. Let's say we wanted to look at consumer staples. Consumer staples has been doing, oh, actually, let's talk about energy, because you all know gas prices are crazy right now. So energy sector is XLE. So let me put this down and let's put that on our chart. XLE. Okay. So again, in this top right, where this daily chart is, you can see it's been kicking ass. Like it's been doing really well, especially yesterday. Wow. Like that's a great green candle. It looks awesome. So this is a really easy way to invest in a lot of stuff that isn't as dangerous as investing in one company, because one company, something could happen. Some news gets out about the CEO like cheating or whatever, and that can significantly tank the stock. Whereas an ETF, again, is a basket of things that can just kind of broaden your, what you're invested in, and that can be a safer play. Okay, so let's talk about now individual stocks, individual companies. The way that I would pick stuff is I would first and foremost start with something that I knew of, like something that I actually liked, maybe Apple. So let's look at this Apple chart. And one of the things that you want to consider in terms of what stock you are going to trade is how much the thing costs. Because some people have much, much, much smaller accounts, and they're going to look for things that are, maybe like $10 or $40 or less than $100. Whereas this Apple, each single share of Apple, you can see here, this green number in the middle, this is where it ended yesterday. So Friday, when the stock market closed at 1:00 in the afternoon Pacific, it ended at 174.73. So that's approximately how much it would cost if you wanted to get in on this on Monday. Obviously, the market's not open right now, so we don't know where it will open up. Sometimes things happen over the weekend or overnight that it can jump up or down when it opens on Monday. So we're just going to say approximately, let's just call it $175. So if you had $175 in your account, you could buy one share. Or if you had, say, $1,000 in your account, you could buy multiple shares. You're always going to look at the math and the numbers in terms of like, well, how much of this stuff can I afford? And how much do I even want? My recommendation is when you place your first trade, do a single share, because then you're not going to screw anything up. Like you're just getting in with one, and that's fine. You can add on later as you work your way into this. But that is something that I would look at. Now, I want to show you a way that is really helpful to know how well these things move. And movement is important, because if you ever see a stock that's like just going, like the chart's just going like this across, straight, sideways, that sucks. Like it is not helpful at all. It kind of like this one down here. It's just like not doing too much. Okay, why the higher and lower green bars indicating, okay, you see now. But let me just clarify that. You know what? Let me actually take that thing off, because that is totally not helping in our conversation today? That, to answer your question, Jeannie, and I think you got this, is this higher one is from this green line up here, but we don't need that. Let me status that thing off. Okay, that's better because we don't need that. And okay, close this. Thank you for pointing that out because that can be confusing. So the green is the current stock one share price. And one of the things that we can do to find out how much this thing moves is something called the average true range. And Engel, you know all about this one. So average true range is essentially how, is how much it moves on, I would say, a day-to-day basis, but I want to show you something specific. Let me put it also on this chart up here, because just so we're clear, the difference between this big chart in the middle, this is a 10-minute chart, which means each one of these candles is 10 minutes long. And then this one on the top right is a daily chart, which means each one of these candles is 1 day long. So let me also put the ATR on here and you'll see the difference. Okay, so on the daily, the average that this thing moves is 4.82. You can see in this little magenta thing here. And this is the line just showing you this level. So that's on the last 14 days. It's always going to be 14 candles back. So on this daily, it's 14 days back. So the average movement was 4.82. You can see the distinction here. This is based on 14 candles back. So that just means 14 candles of 10 minutes each, which is like less than 50 cents movement, because it doesn't move that much, in a 10-minute period. The thing that you want to look for is the higher the ATR, the better. Now, Engel, like our first teacher, Terry, she talks about using only trading stocks that have an ATR of more than 1. My opinion is I would want even more than that. Like 1 to me would be kind of boring. So the higher the ATR, the better. Because what does that mean? It means that you have the potential of almost $5. Let's just call it 5 for easier math. You have the potential. Yeah, Engel says more money. Exactly. You have the potential of making $5 for each day. Now, again, it's an average. It doesn't always work that way. And just to be super, super clear, it doesn't mean it's going to go up that much. It could go down 5 points in a day or up. So you need to get your direction right. And we'll talk about that. But what that means is, let's say you enter the trade. And again, just for some easy math, you're going to enter the trade at 150 when it was down here at this low. That would have been an awesome time to get into it, because you buy 1 share for $150. So your brokerage is going to take 150 of your dollars and say, okay, now you own 1 share of Apple. And then let's say you are doing a swing trade. So you're going to hold it for these days because you're like, heck yeah, I'm making money. It's going up. This is awesome. And then at this point, you're like at 170, you're like, I don't think it's going to keep going up forever. So I want to get out at 170. So you buy down here at 150. Like I said, they take that money out of your account, and then you're going to sell it back at 170 because you don't know how high this thing is going to go. And you just want to kind of lock in your profit and take your money. So you sell it at 170. Now they put 170 back into your account. So what have you made on that single share? $20. That's awesome. And the way that it works out with the multiplication is, let's say you bought 2 shares. So initially that would cost you $300 in the beginning. And when you got out here, you would have made $40 on your initial investment. So that is the way that the math works. And again, it's all about how much you can afford. At the beginning, you want to start with 1 share, just make it super easy, but you can work your way up in trading many, many shares potentially. I mean, you could get in certain stocks, depending on what their cost is, you could get 100 shares or 1,000 shares. I used to trade a lot of this company that was, it was like $5, and I was buying like 1,000 shares at a time. And I'll tell you what, when you have 1,000 shares, you don't need that much movement to make some good money. I could buy 1,000 shares, and if it just moved up $1, well, then I just made $1,000. So that works out really well. So it's all about like how much you have in your account, how you want to do, how risky you want to get with more shares, all of that kind of stuff. Does that all make sense so far? There's still a lot more to come, but I just want to like check in. We're about halfway through. And if anyone needs a little break, let me know. Drop in the chat if you want a little break. Totes. I love it, Ro. Thank you. All right, let's just keep rocking then. Another way to pick stocks is look at CNBC, and I'll show you what you could look at on that. Okay, if you're like, I don't even know where to start, where should I even begin? What you could do is look at recent news. And just as an FYI, these are what I was talking about earlier. These are the indexes. So this is the Dow Jones. It's up, it's green. That's how you know it's up. This is the S&P, the NASDAQ, as I mentioned. Tech recently is having a little challenge. So it is red, and the Russell is also up. So those are just some good bellwethers for the whole of the market to see kind of how things are doing. That's one thing that you can look at on CNBC, just the homepage. There's also an app for CNBC. Now here, they're going to show you some popular quotes and like stuff that's actually moving. So this could be an interesting place to look. Now, one thing to note is that like some of these things are actually futures. This is the US 10-year note. That's what I was trading yesterday and made that $1,000 profit. So that's not an option. But here we go. Apple. Like clearly Apple is really popular because again, it's been cranking recently. But you could also look at this market movers section and just get different ideas of what is moving. And also they'll show you their price. So like this one, Coterra, CTRA, 28.91, and it moved up $1.88. This was on the last trading day. You can also see which ones are like sucking. Oops, I didn't mean to click that. Oh, so that actually had a 52-week high. That would have been yesterday. So that's kind of exciting for them. Energy, like I said, is cranking recently with gas prices and all the things. My goodness. Another one that was in the news a ton at the beginning of COVID was Moderna. A lot of people made a ton of money on Moderna because that stock was flying back in the day. And now it's not doing so hot. So this is a great place to do some research and figure out kind of what's moving, what is being talked about. But really, and I don't think a lot of stock like teachers or educators talk much about this, but to me, it's a really important piece of the puzzle. Is I would want you to pick stocks that either you like that company or you agree in principle with what it is. For instance, in futures, people can trade crude oil. So people have been banking recently with the price of oil and gasoline going up. They're like, oh, Mindy, are you trading crude? Me personally, I don't trade crude because I don't agree that this world, like, I don't think we have to rely, or I don't want us to be so reliant on oil. And I freaking hate how much plastic is on this planet. So if I were to invest and trade crude, to me, there's a little bit of an issue there. Like just my psychology would be a little bit messed up because I'm like, wait, I want to make money on something that I don't even like or don't even like agree with in principle. So I want you to think about that too. Like your own values come into play. Now, sometimes your own values do not make for a good decision. And I'll show you an example of this. Okay, I mentioned my sister works at Allbirds, right? My father, being the nice guy that he is, he was like, oh, when this stock IPOs, I'm going to get some. I'm going to buy some shares. Well, look at this shit. This is the Allbird stock. This is typically what happens on an IPO. It has initial like, whoo, big party, we're going to rally. And then you can see it's been going down essentially from there. So it opened at, what was it, like 21-ish. And now it's at 603. And I was like, Dad, why did you buy that stock? And I know it's because like he's a good guy. He wanted to support his daughter. He wanted to own shares in that company. And I'm like, that to me, as like a technical trader, that's like the worst idea ever. So that's what I'm saying. Not always do the values help that much. So just to be clear on that. Okay, well, we can actually use, let's go back to our Apple example. And let's talk about bullish and bearish, or bulls and bears. You will hear both things. And actually, I'm going to take this ATR nonsense off. I don't like these other lines other than the candlesticks. These other lines and things, they're called studies on TradeStation. Other places call them indicators. They're the same thing. So don't get confused about that. Studies or indicators, same thing. I am just going to take these things off for now. I don't like a lot of extra stuff on my charts. So I'm going to remove that, and I'll actually just take these things off as well for now. Okay, so now we are looking at something. I'll take this one off as well. All right, so this is clean. And I'm going to make these real big so we can look at what's going on here. Okay, so when something is going up, that is called bullish, or you might hear the bulls are in control. In other words, the bulls are buying. Because how does this price move up? It's from when people down here are buying and buying and buying and buying. And this price, as long as there are buyers that keep buying at higher levels, then the price is going to move up. This is considered bullish, just this part right here. So when it's going up, and obviously like this whole section, very bullish, or you might hear the bulls were in control. The opposite is called bearish, or the bears were in control. Now the bears are the sellers. So in this case over here, like the bears took control here and actually pushed the price downward. And then here it got low enough that the buyers came back in and they're like, nope, for the next day, or the next day at this yellow break, the bulls were like, hell no, we're going to go higher. We're going to buy. So essentially just the only thing to remember is bulls is buying, price is going up. Bears is selling, price is going down. Now, the funny thing for me is that I grew up and was born and raised in Chicago. So I'm like, wait, those are the sports teams from Chicago, the Bulls and the Bears. So I don't actually know where that came from. I tried to do some research and find out for you, but apparently nobody knows, because there's a variety of different stories about why it's called Bulls and Bears online. So I don't actually know what is true. So let's talk about us as traders. When we are buying, and ideally you want to buy low and sell high. That's the literally, the bears, exactly. Literally the only thing you need to know is what you want to do is buy low and sell high. Okay. So when you are buying, wherever you are buying, whatever place you are buying at, when you buy, it's called going long. Okay. So if you were to go long Apple, that means you're buying Apple, versus going short means you're selling. So if you short it, you sell it. And again, buy low, sell high. So you're going to sell it at this high point, and that's called shorting. So shorting is going down. Long, you want it to go up. Now, that doesn't mean it will go up, but that is your intention. If you're going long, you're buying, you want it to go up. If you're going short, you're selling and you want it to go down. Okay. I'm not sure why, but that can be super confusing to people, but it's always the same. Buy low, sell high, or with shorting, you would sell high and buy low. So always buy low, buy low, same thing. Let's talk about these individual candlesticks and what they mean. There's a couple different pieces of the candlestick that you need to know. It's essentially made up of a body, which is the colored in part, and then what's called the wick. Like, it's called a candle. So these little things have wicks. These are the white parts on the top and the bottom. So some of them won't have a wick, like this one. It just started and it went up. But oftentimes they will have a wick. And here's how you can read these things, or how to distinguish what they're telling you. So for a green, let's talk about green candles first. Green candles mean the price went up. So that makes it super simple to distinguish. Okay, this one went up, like this one went up, red was down, this was up. So green means up. The bottom of the base, which is the colored in part of the candle, so that could be in this case where there is a wick down, or in this case where there isn't a wick down. The bottom of the green base is always where the price started for that candle. Okay. So that is where it opened. So this is about 171.40. Okay. So that's where the price started. Now, at some point in time throughout this candle, and we don't care what happened first. It doesn't matter like if it went up first or it went down first. We don't care. But at some point in time, the price came down all the way to here, the bottom of the wick. So it started at 17. Let's just call it 171.40, not 17. What am I talking about? 171.40, it opened. At some point during this candle, it got as low as about 171, let's just call it 30, because that's the bottom of that wick. At some point in time during this candle, it got as high as the top of this wick. So about 171.80. And then it closed let's say this candle closed before it moved on to the next candle at the top of the body. So 171, about 72. And as you can see, that then is where the next candle opened. So it closes on this candle here, opens usually at about the same price. Now, if it's moving, like things are cranking, it could do what's called a gap up or a gap down and like actually open higher on the next candle or lower. But in this case, it's approximately at that line. So it closed here, the next candle opens here. Now, in this case, it was moving so fast that it didn't go down at all. In other words, there is no wick on the bottom of this one. So what we know from this candle is this is super bullish because it was just like, nope, we're going up. There's no indecision here. We're just going up. And you can see it. I don't even know if you guys can see this, but on my screen, I can see a teensy little wick at the top of that one. So it like just got a little bit above, and then it closed at the top of the body. Now, open and close, let me know if that doesn't make sense to you all, but it just means like, when did this candle start and when did this candle end, and before it moves on to the next one. So as you can see, it went up, up, and then on this one, perfect. Thank you, Jeannie. It ended up going lower. How do we know? First and foremost, because it's red. So with the red, it's similar except opposite. So with red, it opened here. And that, again, makes sense because it closed here. It basically is that same level of price. So about 172.44. At some point in this candle, it went all the way up. You can see this one has a bigger wick. So the high of that candle was like about 172.67. At some point, it went all the way down to about 172.06. And then it closed about 172.30. So with the green, it opens at the bottom of the body of the candle, because green is moving up. So it opens and then moves up. If it has a wick, it means it kind of danced around in there somewhere, and then it closed at the top of the green. For the red, it opens, or starts is maybe an easier way to say that, at the top, goes up and down with the wick, and the candle ends at the bottom of the red. So I hope that makes sense. I know that in the beginning, you can be like, what the heck are we looking at? What are we talking about? But that is how candles work. So then what do we do with that? We can put all of this together and we can look at bigger time frames and say, okay, like look at this one. This is a great example because this has a huge, high, tall wick. So that means that the price opened up here. There was so much excitement. The bulls were totally like, hell yeah, let's go. We're going to buy this thing up. It went all the way up to here. And then the bears were able to essentially pull it back to like push it back down with selling. And it only closed, that candle closed about here. So you can see there's all kinds of different candles. Some will have wicks, as I mentioned, some will not. Some will have like super amazing, huge wicks. And that is called volatility. It's always exciting when that happens. So, any questions on that, on candlesticks? Because if not, then we will talk about how to actually place a trade. All right. Jeannie says, within the 10-minute time frame, are you able to capitalize on the high point of the wick? Yeah. And actually, let me show you. Let's actually use that as an example because it's such a great, nice wick. And Rose says, makes sense. I imagine it just takes time to make the brain work faster in interpreting. Absolutely. Yes. Like at the beginning, I would be like, okay, wait, where is it closing? Where is it ending? Like what's happening here? And now I just look at it and I know. So yes, it automatically will come to you. Okay. So in this case, let's see where this was. This was on the 24th. So that would have been Thursday at about 10:10 in the morning. And I'm doing that. I'm just basically clicking. That gives me this like cursory thing, which tells me some more information. So what I could do, these charts on the left here are smaller time frames. This one here is a 2-minute, which means each candle is only 2 minutes long. And this one down here is a 5-minute. So that means each is 5 minutes long. So let's see if we can actually go back and look and find that particular time frame. Okay, so that was the 25th, and this would be the 24th. What did I say this was? 10:10 in the morning? Yeah. Okay, so I'm going to have to scrunch this down to be able to see these things. Okay, so this is a perfect example. Thank you, Jeannie, for asking about this. Okay, yeah, and Sheila, I will answer that in just a sec. That's an awesome question as well. Okay, so this one single candle, and you know what? Let me actually look at it on the 5-minute as well, because then you'll be able to compare. That was the 25th. Here's the 24th. And if we scrunch this down, okay, so let's look at actually what was happening. We can see on a 2-minute candle or 2-minute time frame, this went significantly up for 2 minutes. And then that's all it lasted. It was like, nope, we're coming back down. And that all happened. Let's actually put it on a 1-minute time frame. And then you can see even smaller. Oh, now it's going to make me back up again. But there's a lot of candles in a 1 minute. There's a lot of minutes in one day. Okay, that was the 25th. So now we go to the 24th. Okay, here it is. So on a 1-minute candle, it shot up and only lasted 1 minute in this up before the bears took control and were like, nope, we're pushing the price back down, which means, yes, to answer your question, Jeannie, yes, you can capitalize on that, but you have to be real quick. Like you would have to have your buy order in here, or maybe you were already long if you had planned on, just holding it. And when that price moved up, you certainly could get out, but it would have to be fast because as you can see, that only lasted 1 minute before it started coming back down. Now, can you do that? Yes. Like, could I probably do that? Yes. Does it take some time to be able to like get to that point? Yes. So you can see in this 5-minute, it went up, shot back down, and the same thing in the 10. So all of this, these 10 candles here are what is contained in this one candle here. So that's about that big wick. Okay. Sheila says, does TradeStation limit the number of daily trades you can make within a week with a small account? Here's something that you need to know with stocks. The beauty of this with futures is that none of this applies. You can trade as much as your heart desires with futures. which is another reason why I love them so much. And I want you all to, get up there with me and trade futures. But here's how it works for stocks when you have a smaller account. If you set up what's called a cash account, which in other words is, I'm going to have to go into a little bit of this. There's something called margin. Margin is essentially like credit. Like your brokerage is going to give you some credit, kind of like having a credit card, and you can trade with more money than you actually have in your account. If you have a cash account, you can only trade, obviously, with what the amount of cash that you have. The distinction, and this is why it applies to your question, Sheila, is that with a cash account, you can trade in and out as often as you want, because they're like, hey, it's your money. We're not giving you any extra credit. Like, you're just putting in the cash. The only distinction to note with that is that it has to be settled. And so that means if you make a profit on a single day, you can't then turn around 5 minutes later and use that money to make a new trade, because it hasn't settled yet. It will only settle like once every day. So after the stock market closes, your account will settle, and then you can trade with that full amount the next day. So that is the one distinction. With a cash account, you can do as many trades as you want, but it has to be settled in your account. The other option is to create or open up a margin account. And again, margin is kind of like credit, so that it is giving you more access to capital to trade on. You don't have to have as much money in your account. And if you have a margin account, then you fall under something called PDT, or pattern day trading. Now, this to me is so annoying because it's basically like the government came in. Yeah, exactly. TOS only allows 3 day trades within a week. Yes. So this is what PDT is. The pattern day trading rule states that if you have less than $25,000, but again, this is only on a margin account. So Sheila, if you were to open a cash account, it's different. So, and this is not just TOS, this is across the board in the United States, because it's a government requirement. The pattern day trading rule is that only 3 day trades within 1 week, unless you have over $25,000. Now, again, this is annoying to me because I'm like, yo, if it's my money, like, why can't I, they're trying to like protect the little guy. And that to me is annoying. I'm like, why don't you just let us make up our own choices? It's our money, what we want to do with it. If we want to lose it all, fine. Like, let us do that. But they're trying to protect the little guy that has less than 25K. And I'm like, actually, they should be bolstering them up more. If they have less money, like, they should give more opportunity. But, government, that's not how that works. So that is the deal with PDT, or pattern day trading. It's all based on that $25,000 account when it's a margin account. If it's a cash account, that does not apply. So that is something to think about when you're opening your account with whatever brokerage. Is you want to look at, like, okay, do they offer a cash account? Do they offer margin accounts? Obviously, most of them offer margin accounts, but PDT does apply. So you can only do 3 day trades within 1 week. And just to confirm, a day trade is when you would be opening the trade or entering the trade after the stock market opens, so after 6:30 in the morning, and you would be closing out that same trade before the close of the market, which is at 1 p.m. Okay, so let me know if that all makes sense, because there is a distinction with the cash versus the margin accounts, but I think it's super annoying. But unfortunately, it's just how it is. It's a government thing. So again, it doesn't matter about which brokerage, because it's not a brokerage deal. It's a government regulation deal. So whatever, we have to deal with it. All righty. Let's talk about how to place a trade. And we're also going to talk about how to exit a trade, because I know, like, Engel, you may have seen this in the group that we are in, but some people get into a trade and then they like freak out because they're like, how do I get out? I don't know how to get out of the trade. And that can be really problematic if you were in it and let's say you were profitable. So you're like, cool, I want to get out, and you don't know how to get out. So then the trade starts going against you. Engel, yes, you have. And if it's like, oh, I don't know how to get out of here, then that is a big issue. So I want to make sure that you know how to get in and that you know how to get out. And Sheila, thank you. I appreciate that. So the way that, and this is one of the reasons that I love TradeStation so much. They have this thing, this column thing that you see here in the middle. This is like a trader's best friend. I absolutely love this thing because on the web version, while they have it, it doesn't actually work that well. So I was having to manually put in all of my trades when I was trading on the TradeStation web version. And then when I moved up to this desktop platform and could use this thing, this is called the Matrix. It's actually, that's just the TradeStation name for it. It's actually called the DOM. It's DOM. It stands for depth of market. And lots of different platforms have a DOM. They may call it different things, like obviously TradeStation calls it the Matrix. Why? Who knows? But whatever. This thing is freaking awesome. The best thing about this is it makes it so easy to place your buys or your sell orders. I got to move this little chat thing over so I can see this. So unfortunately, the market is not open right now, so I can't show you a live example, but here's what I would do. Let me scoot this over to current time or yesterday's day. So let's say I was day trading and I was watching all this nice upward movement, and then I saw it come down and flatten out. Oftentimes, now again, not always, but oftentimes what will happen is with these candles, there will be movement up or movement down, and then a period of consolidation, which is this right here, where it's going sideways. Because it's like, this was obviously very bullish, buying, prices continuously going up, 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 up. I mean, with little red candles in there, but overall, the general momentum was up. And then it got maybe too high, too big for its britches, and was like, phew, bears came in, they're going to push the price back down. Then you see this period of consolidation. Now, what I might look for as a day trader is to say, okay, from this consolidation, I know that it's either going to go up or it's going to go down. It's not going to consolidate forever. So one of the things that I could look for is like, it's kind of just trading back and forth between like essentially this high and about this low. And then when it breaks out of that, that can be a great place to enter a trade. Again, either long or short. Okay, so after this consolidation, what I would look for is, it looks like it's breaking out. And then especially on this candle, that's a bigger candle. So I'm like, heck yeah, let's go long. And the way that I would actually get into that is there's a couple things that I could do. Over here in my matrix, I could decide that I want a specific price. I could say, and you can see this price column here, it's showing all of the current prices. So I could say, well, if it breaks out, I want to sell, or I want to buy, at around this level. So 170, let's just call it 170. That would be too high. 173.78. Let's just say we could do that. What I could do is I could go down here to 173.78, which is right here. And this blue column is for buying. This red column is for selling. But I could go to 173.78 and I could place a buy order. Now, this is crazy. This has 500 in here. I don't want 500. I want 1. So 173.78, I would go here and you can see it's buy 1. And I would just click that. And it's like, yeah, markets are closed. Yes, I know. But all I would do is click that. And then what's cool is, and you'll be able to see this on some of my Daily Rage videos because I'm actually showing live trades, but it's going to show you where the current price is with this yellow bar. So it's going to be moving up and down as the price varies. And what I can do then is I can do a few different things. I can either enter wherever I want, and trail it. Well, let me back up. I'm getting a little excited here. So that would be how to enter a trade. Let's just say I wasn't having any other setup. I just got in. I didn't have a stop market set. I didn't have anything else set. Just got into the trade. That would be how to enter. And again, if I wanted to sell it, now just to be clear, with selling on stocks, you do often have to have a margin account. That depends on your brokerage, but lots of them would require a margin account. And it takes more money to short something than it does to buy something. Why? Because in a sense, this is what confused me at the beginning with shorting, otherwise selling or wanting the price to go down. You sell first, you sell high, and you buy low with shorting. But I'm like, hold on, how do I sell something that I don't own yet? Like, it made sense to me going up because I'm like, okay, I'm buying it here. And so then I buy it, I own it, it goes up, and I sell it. That to me made total sense. But I'm like, how do I sell it first if I don't own it yet? That made no sense to me. But the reason that this works is you're essentially borrowing shares from your brokerage in order to sell, which means they're often going to cost you more. And I'm not going to go into the details on that because it is brokerage dependent on how that works, but make sure that you know that shorting, and this again is just in the stock market, because in futures, doesn't matter. You can go long, short, same price, super easy. But with stocks or ETFs, it is like you need more in your account than just the, 175.29 for one share. So make sure that you know for your brokerage, shorting can get expensive. In stocks, yes. One more reason why y'all want to jump into futures eventually. So that is something to note, but you borrow the shares up here, and here's how you borrow them. You don't have to do anything. Literally, you would just place an order to go short. So you would pick your price in this column that you wanted to short it. You would click the button, and you can see if you look in this column, as I am scrolling in here, it actually tells you what it would do. So this would be buying. This in the red column would be shorting, and like one, and I could short it wherever I wanted. The ways to get out of a trade, okay, there's a couple different options. If this were live, there would be a big button on the top that says cancel. So that would get you out of the trades. That's like kind of a like eject, like get me out. Let's be done with this type thing. Also here, if I was in a live trade, this button would be colored. So obviously it's all grayed out now because nothing's open, but you could close here, and that would close out all of your open positions. Let's say you had some orders staged that weren't actually in play yet, but you didn't want them anymore. You would use this button, cancel all. That would cancel all the orders. But if you're actually in the position and you want to close it, this button down here would help you with that. Now, in terms of where you would pick your quantities, this would be your account number. So you can see this is my SIM account, which is great to jump into, play with, see how things operate, because it's all fake money. And I think I have like look at my buying power down here, $4 million. So my SIM is out of control. I got cash for days, $4 million worth of buying power in my SIM. That's so awesome. So this quantity here, I could say, I don't want one, I want 10 or 100 or 1,000. That's where you would change your quantity. This is super important, especially if you're going to be a swing trader or a long-term investor. Duration. You always, please, like if there's only one thing that you remember from this, do this. You always want it to be GTC. And I don't know why the default is day. That's super dumb because really nobody wants day. You want GTC. And here's what the difference is. If it's on day, that means that if you put in a trade, and as I'm going to teach you in a moment, you have a stop market, or otherwise known as a stop loss, which means if it goes too far against you, you're going to get out of the trade. If you had this on day, it would cancel your stop loss order or your stop market order, which means if you are holding something overnight and then whatever happens, the company gets terrible news, another war breaks out, whatever, and you had that at day, it would not have your current stop market in place. It would cancel that order, which again is so stupid. It should always default to GTC, but it doesn't. So you need to make sure that your orders are GTC. GTC stands for good till canceled. And that means it's going to stay in place until you do something, like until you change it or you cancel it. It's not based on time frame or anything like that. It is going to stay. It is good till canceled. So that's super, super important. Again, if you only take like one thing from this whole presentation, make it be that. Change your orders to GTC. Then here is a way to enter what's the way that I would set up a trade, which is an order sends order, or OSO. So I could click this little button, and there's a whole lot of different things. I'm not going to go into all of this right now because you won't need all of these things, but the easiest way to do it is to do exit 1L 1S, which means one limit, one stop. So I would pick that one. And what that essentially means is you're creating a bracket. So let's say I wanted to enter at this current price of 175. And then I was like, I don't want to lose more than $1. So I enter the trade long. So I'm buying. I want it to go up, but I could set my stop market or stop loss to be at 174, which means if the price came down and hit 174, it would get me out of the trade and I would have lost $1. Now, obviously, that's not going to give this a whole lot of room to wiggle around because, as you can see, the price moves up and down. So you do want to give it space. But just for our example, we only want to lose $1 max. So we would set our stop loss for 174. And let's say that we were like, we don't want to be a long-term holder on this thing. We just want to be able to make $5. So we are going to set what's called a limit order. If we enter at 175, we would set our limit order for 180 because that would be way up here. It's almost past our chart, but 180, that would give us $5 of profit. And we could set up, it's called a bracket because you're entering and then you're putting in basically where to get out at a loss and where to get out with profit. And that can work both long and short. So if we were going long, this would be our entry. Our stop loss would be somewhere below that price because we would set our max stop, however much we wanted to risk on that trade as a potential loss, and then it would get us out. And our limit would be somewhere above. And that would be like, it's in some brokerages, it's called take profit. It's also called a limit order. And that's like, get me out of the trade with my money. So somewhere above the current price would be where your limit was. Now it's just the simple opposite for shorting, because in this case, if we got in at 175, let's say we looked at this and we're like, we actually think it's going to go down from here because clearly it didn't get that much higher than this. So we think it's going to go down. And this is just totally fake because I don't actually think that, but just to be clear. So in this case, 175 would be our entry. Our stop loss would be above somewhere because if we're shorting it and we want it to go down, we want the price to come down this way. So our take profit or our limit order would be somewhere down here. And our stop loss or stop market would be up here somewhere. And TradeStation makes it super easy to do that. If we click this little three dots on this button, this shows that you can set your limit order and your stop market. And let's say we said, okay, we want this to be $5 and $5. So we're either going to make or lose $5, whichever happens first. We could say, okay. And then what we would do is there's two ways to then enter the trade once that's set up. So we could either use these buttons here and buy or sell with the blue or the red column, or when it's buying at the market or shorting at the market, that just means you're going to get in at whatever the current price happens to be at that time. So if I wanted to buy from here, I could just click this, buy market. Obviously, it's like the market's closed. And what this is doing, though, this is how you could set it up when the market's not even open. So for those of you that have super busy schedules, if you wanted to look at night or over the weekend, because I have a GTC order in here, what it would do is essentially it's saying you're placing a GTC outside of the regular session. Click yes if you want to make the order available for the next regular session. So what that means is as soon as the stock market opens on Monday, it would get me in at the market price. The market price is always the current price at that time. Now, one risk, just to be super clear, one risk with doing that is you don't know what's going to happen when the stock market opens the next day. There could have been company news. There could have been some, geopolitical situation that developed. And if you're like, oh, I think Apple's rocking, I want it to go up, and I'm just going to buy at the market so that it gets me in at whatever the current price is on the next day. Well, let's say that when it opens on Monday, it gaps down for whatever reason. Something happens and it's like way down here at 170, and then it just continues to go lower throughout the day. Well, that's a problem because you thought that it was going to go long and you wanted to just get in at the market, but you bought it instead of shorting it. So I hope that makes sense. Let me know if that doesn't make sense, but that's one risk that you do have when you're placing orders when the market is not open. That being said, you can give yourself some space with a stop market that is going to give this room to wiggle and jiggle around. And it's not like the worst thing in the world, but I do just want to make sure that you know that there is that risk when you are placing orders when the stock market is not open. There's two other orders that I want to mention in this case, and that would be a trailing stop. Trailing stop is kind of a cool feature because this is more of like a set it and forget it type of plan. Let's say we got in long, so we bought it at 175 here. And we set our initial stop to be $5 below that because we don't want to lose more than $5. So we set our stop market to be at 170. So again, entry at 175, stop market or stop loss, same thing, at $170. Well, that's just going to stay at $170 until we do something, like until we manually move it. But the cool thing is with a trailing stop is that it will automatically do it for you in the sense that as this price moves up, your stop loss will also move up. So if this price goes from 175 to 175.02, your stop loss or your stop market is going to move from 170 to 170.02. And it will just continue to automatically trail the price action. So again, if the price action moves up, your stop will move up. That's a great way to do it. Set it and forget it, because then you don't have to manually worry about it. You don't have to manage it along the way. So I do want to just mention that there is a trailing stop. And then, as I said, this thing is an OSO. That's order sends order. What that means is if we're in here and we have our bracket, which is, let's just use $1. So we're in at 175. Our stop loss is 174. And our take profit or limit order is at 176. So we're either going to make a buck or we're going to lose a buck. Super simple. And the order sends order, OSO, is that one of those two things will happen first. It's either going to come up in price and hit our 176 target and get us out with $1 profit, or it's going to go down and hit 174 first and get us out with $1 loss. What's cool about the OSO is that essentially, when one of those two things happens, it cancels out the other one. Because just think about what would happen if it didn't. So we have 175. So can't do OSO and trailing stop. You can. Yeah. And it's just slightly different. Basically, you would set we would have bought here at 175. We would have an order at 176 to sell. and we would have an order at 174 to sell. So to get out of a buy or to get out of a long, you have to sell. Doesn't matter like what's happening, you're going to sell either way because you bought to get out of it, you sold, and vice versa for shorting. If you sold to get out of it, you buy. And that's that case, let me just mention this. That's called buy to cover. Cover, you might have heard the term cover your shorts. Buying to cover is getting out of a short. So again, our bracket is 175 entry. Take profit because we're going long at 176 and take our stop loss or stop market. We would have lost $1 if it goes down to 174. If it didn't do that, like when one will get the other one out, like one will cancel the other one, think about what would happen. If this was at 175 and the price did go up to 176, we had our sell order in there and we're like, sweet, we made $1. Woohoo. But if it didn't take out that other order, it would still be in the system, which means we still would have a sell order down here at 174. So even though we made our profit to the upside $1, then let's say the price comes back down to 174 because as you can see, it jiggles and wiggles around here. We would have a sell order at 174. Well, we might not want to short it at 174, especially when Apple's been doing so well recently. So that is why like using the OSO is really great because one will get the, like once one thing happens, it will take out the other one. It will cancel the other one. OSO, and this is potentially going to be confusing, but there's a really easy way to think about it. OSO is for entering the trade. So your OSO is going to do three things. It's going to enter you at whatever price. It's going to have a stop loss, and it's going to have a limit or take profit order. But let's say you just jumped into the trade and you didn't do this OSO thing. And you just were like, I just want to get in. I need to get in right now. So I bought at 175. And then I'm like, crap, I don't even have a stop market in there. I don't have a limit. I don't have anything in there. In that case, when you're already in the trade, instead of OSO, we do this other thing called OCO. And the difference is this is order sends order. This is order cancels order. It's basically the same thing. The biggest distinction is that OSO is to enter the trade. So there's like three things going on. There's an entry price, a stop market price, and a limit or take profit price. And then OCO is once you're already entered and you just want to create a bracket around it because you're like, crap, I did not put in a stop. And my advice to you, always, 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 always use a stop because that can really get you screwed up if you do not use a stop. So those are the different ways that you can enter and exit a trade on TradeStation. Again, this is going to be different based on different brokerages, but they're all going to essentially have the same thing. They may be called different things. It might not be called an OSO. Like for instance, in the other another platform that I use called Ninja Trader, it's not called OSO in there. It's called it's an ATM, automated trade management. But essentially it's an OSO. It's the same thing. So depending on your broker, might be different, but they're always going to offer you some sort of like bracketing things. Now, the way that I like to do it is to not necessarily have a take profit order because I like to have as much potential as possible. So why cap my potential profit? So that's the way that I do it is I usually just have a stop. I don't necessarily have like a target, if you will. But that's personal preference. You can set it up however you want to set it up. One thing I do want to mention, this is something that you will hear again and again and again. Two terms, support and resistance. Support and resistance. And I want to show you what that looks like. Scrunch this up a bit. Okay, support and resistance can be used on any time frame. And here's the way to think about time frames. The shorter term trader you are, the lower the time frame you're going to use. Okay? So this over here, when I change this to a 1 minute, that's a little crazy. Like that's just too short. The smallest time frame I use to trade is a 2 minute. So this is what I'd be looking at. 2 minutes. And of course, this was our 5-minute. This again is a 10-minute. So support and resistance is the same on any time frame. I'll show you like on a 10-minute, and we can even start here and then go up to a daily just so you can see the distinction. But basically, support is a bottom, okay? It is supporting the price level. And the ways that we can look for levels of support is to see where things bottom out. So like this is a good level of support. Why? Because the price kept coming to about this level right here. And then it didn't really, there were a couple ones that like kind of got below that a bit, but not really, not significantly. So this would be a level of support. And support, again, is the bottom that things go down to. So we could, and it's not a single line. Like it's not like, oh, support is at 172.90. No, don't think of it that way. It's a general area of interest. When you see a strong area of support like this, oftentimes what that means is that price isn't necessarily going to go below it, because look at all these candles. Like it went up, it came back down, didn't go below it, went up, came back down, didn't go below it, went up, and then it just broke out of that consolidation and went up higher. So that would be support. The way that I like to think about support is like a trampoline. Okay. So price is going to come down, bounce off the trampoline, come down, bounce off the trampoline, come down, bounce off the trampoline. And eventually, like I said earlier, with consolidation, it's either going to do one of two things. It's either going to break out to the high side, which in this case it did, or it's going to break out to the low side. And when that happens, it's almost as if it's like the trampoline got weaker and weaker the more it got bounced on. So the more you use it, like the springs kind of wore out. And eventually, if this were to have gone down instead, it was like, bam, we're bouncing off. Bam, we're bouncing off. Bam, 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 bam. And then finally, the trampoline's like, yo, I cannot hold you anymore. So it goes down. In this case, though, it had a nice spring at the end and bounced its way up. So that is support. Let's talk about other areas of support. This one, maybe. Now, this one was not as long of a consolidation, so that might not be as strong of support. Like this one was bigger, but this one, I still might look at this level as like, I just want to pay attention to that. Okay. Another one would be about here, because look at what happened here. Both this one from this day and this one were approximately at the same level. That might be another area of support. And support, just to be so clear about this, it's not a science. Support and resistance. It is not like a technical thing. It's not a scientific thing. It is a general area of interest. Okay. So other people may look at the same chart and have they might see completely different areas of support. Another way that I like to think about support is when there's a significant bounce up on like one candle. For instance, here, that I would want to pay attention to, because I'm like, wow, like it was going all this way down, started its way down here, and then took off from there. So that's kind of interesting to me. But in general, the more you have in that segment or that area of interest, the stronger it is. So that's support. The opposite is called resistance. So resistance, same thing, but it's going to be on the top. So let's look at that on this day. So starting at this yellow line to this yellow line, this day, the resistance was about here. Because you can see it kind of tried to get up there, and this candle didn't make it. But then in this segment, it hit it, came down, hit it, came down. And that acted as resistance. So just like I think of support as a trampoline, I think of resistance as a ceiling. And anytime you are hitting the ceiling, eventually there's going to be one of two things that happen. Again, it's either going to break out to the high side. And when it does that, it's like you've hit that ceiling so much that eventually you busted a hole in it and you went higher. That could happen. Or you just kept hitting it. And finally it's like, I got nothing. I'm going back down. So support is a trampoline. Resistance here is like a ceiling. And the way that you use that to figure out how to trade is you can look for those areas of interest and be able to make your determinations based on how the thing is moving. So if you were doing day trades or very, very short-term trades, you might look for support and resistance on a 2-minute, a 5-minute, or a 10-minute chart. Let's say you were looking for more swing trade type things. Let's look at this daily chart here. And for now, I'm going to take off that average true range because we don't need it. Okay, so in this case, again, each candle is a day. Let's scrunch this up a little bit more. And oftentimes the way that stock prices will move is they will find previous support or resistance levels. So look at, this is a pretty great example actually, because if we look back here to last November, this whole like consolidation stuff here was a pretty good level of support. And you can see that even when it came down here, it never like fully got to that. Same thing here, all the way down here. That's not that far off from this level of support. And once again, bam, once like here, that's actually at that same level. So looking backwards in time or backwards in history, we can find levels of support or resistance, and that can help us determine if we think it's going to go up from there, because like it held it here, it held it here, it held it here, it held it here. Each time it bounced its way up. But we can also use that on the top side if we look at resistance and we can think, okay, well, if it was up here, the likelihood that it will get back there is fairly strong because that's where the resistance was earlier. Now you can see in this case, there was like stronger activity because it didn't actually get back up to these highs. It like got up here and then it was like crash going down. So it's not, again, this is not a science. It's definitely an art looking at support and resistance. And there isn't like a right way and a wrong way to talk about support and resistance. It's simply the way that like you learn to read the charts and what you see on it. Because like I said, some people could look at the same chart that I'm looking at and they might see completely different levels. For me, I look for things like consolidation. I also look for like jabs down. Like this one is a jab down. This one is a jab down. And even this, there's only like 2 candles down here. That's a jab down. So I would look at those as levels of support, which then would make me think, there's a high likelihood that it might go up. So that is what I have for you today. Again, thank you for indulging me in my passion and my interest in this stuff. I didn't hide the fact that I really, really, really want you all to be trading futures with me because there's a lot of benefits to trade futures. But if you don't know how to trade stocks, first and foremost, the potential that you would just get crushed in futures would be high. So I don't want that to happen to anybody, of course. So that is the intro to the stock market and trading basics. Do you all have any questions for me in these last couple minutes? Okay, Sheila, can you place a trailing stop if you've already bought a stock, i.e. buy it after the fact? Yes. And that's actually a cool way to do it because you may want to see how it's going, right? Like, here's a way that I might use that. I might get into a stock intending, or any trade, I shouldn't say a stock, any trade. I might get into something intending for it to be a very short-term play. But then let's say it's freaking rocking and I'm like, oh, heck yeah. I just want to keep that thing going. At that point, I may, depending on the situation, I may want to use a trailing stop so that I don't have to like keep looking at it or manage it. I'm like, cool. Like I just want it, if it keeps going up, I want to go up with it. Right. So yes, you absolutely can do a trailing stop after the fact, which can be very, very helpful in certain situations. Ro says, this was an amazing dive into trading basics. Thank you. You are so welcome. The simulator thingy, is that an opportunity to play with the software and fake trade so I can get more comfortable? Yes. And almost every platform has their own simulator, which is great for two very, very, very important reasons. One, so you can learn the technology, like just learn where the buttons are, learn what does what before you're actually playing with real money. And I always like trading on like a big sim account because it just makes me feel good. I'm like, I'm a millionaire, $4 million, $4,023,599. That's awesome. But here's an example. When I was using TradeStation to trade futures, and then I opened up a Ninja Trader account also to trade futures because they have better margins. I got into Ninja and I'm like, crap, like I know how to trade, but I didn't, I did not know how to use their software. So I ended up screwing up quite a bit of things. And if I had spent more time in the sim for Ninja, I could have, gotten my execution down a little bit better and might have not lost as much money as I lost, but I like to risk. So that's just me. But yes, simulators are awesome. So you would have to just set up a trading account at one of these things. And then you get a sim. You get a sim account and you can here's the other thing is you can always reset your sim. So let's say you completely blow it up and you lose all the money. You could just go in and reset it and they'll give you like $100,000 more dollars or $1 million more dollars, whatever you want it to be, which I especially like. So yes, I do recommend playing in the sim, seeing how the execution goes, and then also just like getting to know your market, getting to know whether you pick a particular stock or an ETF or whatever you decide to trade, eventually futures, you will see how it moves because you can look at it in real time and all of that stuff. Sheila says, awesome job, Mindy. Thank you for your guidance. Thank you. Thank you. Thank you for being here. Agree. Awesome job. Thank you. Thank you. Thank you. I really appreciate you all for being here. And like I said, indulging my passions in this. If you have any questions, like please reach out. If you have questions about brokerages, if you have questions about entering a trade, whatever, anything. One, there is the content for you in the dashboard. You can certainly go back and do that. Also, watch my daily rage videos because I'm always talking about trades that I'm doing and different things to think about. And yeah, definitely reach out. Do not be strangers. I want you to like be profitable and all of this stuff. I think I forgot to say this at the beginning, but y'all know none of this is guaranteed. There is no guarantees. There are no like absolutes in trading. Lots of people do lose money in trading. So just know that going into it. But I'm really excited for all of you and cannot wait to see you all as just rockin' profitable traders. So with that, I'll let you get back to your Saturday. Rose says, I can see how this could get addicting and how passion can grow. Constant learning and growing. Yes, ma'am. And there's power in knowledge. Friggin' awesome. Yes, 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 yes. And there's power in like, I've already made a lot of the mistakes, so I'm going to share them with you so you hopefully don't have to do them as well. So power in community. Yes. This is awesome. All right. Like I said, I will let you get back to your Saturday now. Thank you once again for being here. Have an awesome weekend. I'll talk to you guys soon.